Hi, everyone. Welcome. It's Marcy here, and I have Rolanda McDuffie. Rolanda, thank you so much for joining us today.
Thank you for having me.
Love having you.
Glad to.
So tell everyone a little bit about yourself, what you do, fun stuff about you.
Sure. So my name is Rolanda McDuffie. I am a certified public accountant. I have a CPA firm, a full service CPA firm in which I specialize in working with for-profit businesses as well as nonprofit organizations, getting them financially fit through the areas of accounting, tax, business advisory services, as well as trainings to businesses to help them grow their organizations. Some fun facts about me. I guess I'm not your traditional CPA. I love to laugh and I love adventure and I love to travel. So probably fun fact, one of the most adventurous things I've ever done is gone shark cage diving off the coast of South Africa. So a little adventurous there.
Wow, that sounds amazing. We'll have to do a whole webinar just about that. That probably was an exciting experience. Today, we're going to talk about something less adventurous. Hopefully, I'm not sure that anyone's accounting should be super adventurous here, but let's talk about accounting in terms of being a 1099 contractor or subcontractor. That presents challenges of its own. So let's talk about like what should we be tracking? How should we be tracking the information? I remember, back in the day, people would throw their receipts in a shoebox, but we're hoping that we've advanced technologically from there and everyone has some sort of platform. What's the best way to track all of that information?
I would say the best way to do that is using accounting software, simply because it allows you to look at your information in a lot of different views instead of just one static view of this current month or this current year. You're able to look at it month over month, quarter over quarter, year over year, kind of do an analysis, maybe even week over week, right? And so it just allows you to also have that detail, that underlying detail that allows you to drill down further to understand exactly what's being recorded within that total line item. Outside of that, the next thing would be a spreadsheet, whether we're talking about Google Sheets or Excel spreadsheets. At the very least, if you're not using accounting software, that would be the second option to making sure that you're just keeping track of your profit and loss statement from that perspective.
Okay, great. And so for notaries, most of us are the 1099. We go out there and do the job, and then we get 1099 at the end of the year. Most of us are mobile, we drive, we go through tons of office supplies. We don't normally have offices, we're at home. What kinds of expenses should we be tracking, or what should we be watching for as we go out there and spend money toward our business? What is good information to hold and keep for our accountant or for tax purposes?
Great question. So, especially if you're out traveling, or even if you're not traveling on a regular basis, you still should be keeping track of your mileage or the actual expenses related to the vehicle. But regardless of whether or not you choose to go the actual business, or excuse me, the actual cost of running your business, or excuse me, the actual cost of repairs for your vehicle or the standard mileage rate, either way, you need to keep track of your mileage driven for business purposes. A great way to do that would be using something called Mile IQ or Everlance. It's great software that you can download on your phone. And the great thing about it is these softwares, they will track the mobility of your vehicle. So it can tell when you get into the vehicle and start moving. And then when the vehicle comes to a stop, it'll ask you whether or not it was a business expense or a personal expense. And you can swipe left or swipe right. And so what that does in the background, it keeps a track of all of the mileage that you've driven for the year. And then at the end of the year, it provides you a nice little spreadsheet that you can print out that has the total miles driven for business as well as personal, and in a total column. And then you can print that out and give it to your tax professional at the end of the year. That will show them the mileage that you've driven for the year. So that way you don't have to worry about necessarily keeping a little mile book in your vehicle, keeping track of the beginning and ending mileage for that particular trip. So that's one way to do that from an electronical standpoint for mileage. The other thing you want to keep track of, especially if you're working from home, and you don't have an office, then you're able to claim the home office deduction as well. So with that being said, there's not a lot that you necessarily have to keep track with throughout the year, but just making sure that you're keeping up with your expenses that you're spending within your home to be able to calculate or offset those amounts against the income that's earned throughout the year. And so usually that's done through a percentage of your home office space. So for example, if you have a home office that's 10 by 10, which is 100 square feet, and your entire home is 1,000 square feet, you would divide the 100 into the 1,000 and then get that 10%. So you would be able to deduct 10% of the cost associated with your home to write off against your business throughout that year. So that's kind of how that home office deduction is calculated. And then of course you have supplies that you would need in order to run your business. The IRS kind of, the way that they define it is if it's a necessary and ordinary expense for you to run your business. So if it's something that you need in order to run your business effectively and efficiently, and it's an ordinary expense for someone in your industry, then you're able to include that as a tax deduction. That's kind of an overall view of what is considered a tax deduction, and kind of a good cheat sheet, I guess, for you to use as well.
That's great. And I love that app that you can put on your phone for when you're driving, because lots of people just mark the mileage when they get in their car, right? And mark it when they get back out. So how much easier is that? What about sort of like indirect expenses? Let's say I'm on the road all day going to appointment to appointment and I stop and get something to eat. Can I claim that meal, or is that something completely separate? How about things like marketing and advertising? What about membership fees? Like, let's say I decide to join my local chamber of commerce. Are those expenses that potentially could be written off?
Yes. So everything that you just listed, marketing, chamber of commerce, those types of industry or membership organizations that will help you get more business, or to help you grow as a business as well. Those are expenses that are written off, so, as well as conferences and seminars and trainings that are helping you to expand your business or expand your knowledge in your particular industry. Those are also tax deductible as well. So you're able to write those things off as well. I'm sorry, you asked another question and I can't remember.
Oh, that was pretty much the majority of that. That's great. Is there anything that you think entrepreneurs out there don't think to claim or track? Like, is there one of those things where you see that you ask the question and they're like, oh, sure, I did do that, or I did have that? Or do you think that most of us do a pretty good job of tracking what we're supposed to?
I think the biggest expense that is always missing would be that mileage, just because so many people forget to do it in the time of moving. I think that they know in the back of their head that they can write it off, but it's just always something that I think most self-employed individuals tend to forget. And it's not just about going to clients' locations. It's also about if you're going to these conferences or seminars, so anything that's related to business, even if you're going to Staples or Office Supply or Office Max to get supplies for your business, those are even considered business miles as well. So those are some things that you want to consider. Oh, it was the meals. You asked me about meals, and I wanted to
sorry,
address
yes,
that.
I did.
So with the meals, that is an area that I think that a lot of small business owners get themselves in trouble. Because basically the way the IRS looks at that is if you are taking a potential client out, or a client, or someone within your office, or something that's related to your business. So it has to be another individual that's at that dinner, that lunch, that breakfast, in order for it to be a tax deduction. It can't be just a matter of you being out and moving around during a business day and then being able to write that off. It has to be in a situation where it's business related and you're having a conversation with someone. So the purpose that the IRS allows that to be 50% off is because you're able to write off the other person's meal, not necessarily your meal. And so that's why it's typically 50% off in that manner.
All right, that's great. And so I'm going to go back to the mileage for a minute. So many of us drive to FedEx or UPS to drop off packages, right? We could log that mileage as well and could claim that. Is that what you're saying? Oh, no, I bet you
Yeah.
lots of notaries out there don't do that. Everyone pay attention. That's a good thing to say.
Yes,
Um,
yes.
oh, go ahead.
Oh, no, go ahead. What were you going to say?
Oh,
I
I
was
was
just
gonna say,
confirming.
yeah. So that's great because I don't think that most people think to do that. So we talked about having a home office and the expenses and obviously direct expenses like paper. Um, when it comes to so now we're 1099, so we have to pay all of our own taxes. So there's two schools of thought. Some people just like to the end of the year and then make one big payment, I tell you. And some of us make estimated quarterly tax payments. Can you talk a little bit about that and what would be the benefit or the pros and cons to either or one of those
Sure,
options?
sure. So when it comes to estimated taxes, you are not required by the IRS to pay estimated taxes until you owe $1,000 or more the previous tax year. So if the previous year you owed $1,000 or more, then the current year you should be doing estimated taxes. The great thing about filing estimated taxes is you don't have that big tax bill at the end of the year because you've gone ahead and paid it throughout the year. If you are required to pay estimated taxes, there will be a penalty that's applied to your bill at the end of the year. In addition to that estimated tax amount, the IRS will automatically add that penalty for you not paying estimated taxes. I would highly advise business owners to go ahead and set themselves up with those estimated taxes and start paying that throughout the year. That's going to be the best strategy for you. And then I think something else that a lot of business owners don't realize is that so in addition to paying federal taxes at the end of the year, you're also required to pay your FICA and Social Security on that income from a employee and an employer perspective, because when you're self-employed, you are then the employee and the employer. So Social Security is 6.2%, and then your FICA is 1.45. And so that 7.65% that you have to pay just on the employee side, but then you double it. So it's the 15.3% that you're paying in self-employment tax, in addition to the federal income taxes. And so I don't think business owners often take that into consideration. They just think about the federal taxes. But even as employees, you have to still pay that Social Security and FICA, and then your employer pays the other side. So it's now you're just responsible for paying it as a self-employed individual.
That's good information to know. Now, let's say I decide to go ahead and make quarterly payments and I pay too much. At the end
Mhm.
of the year, will they refund an overpayment to me? Can I apply it toward my next year's taxes? How does that overpayment work?
Great question. So yes, you can, they will refund it. So if when you file your taxes, it would just be your estimated taxes will be included in the tax calculation, just like you would receive a refund in any other instance. That refund will be provided to you in the current year. If you owe taxes previously and there was a tax debt owed, they will just apply that refund amount to what was owed previously to them for the IRS debt.
Are there any
So
certain pitfalls? Oh, go ahead.
no, I was going to say, so you won't lose your money even if you do overpay.
That's what we
You'll
want
get
to
it
make
back.
sure no one's losing their money, right? We want to make sure we get our money back. And certainly if you have a hard time holding on to all of that money at the end of the year, or you don't want to make that big lump sum payment, right? You're concerned. That's sort of where quarterly comes into play. That might be helpful for you. But are there
Yeah.
certain pitfalls? And I feel like there might be, when you're self-employed, anything in particular that self-employed individuals really need to pay close attention to, red flags that would flag the IRS to be like, okay, this is a problem. Like, is there anything in particular we should be watching for?
Sure. So red flags for sure if your home office deduction is really high, or your standard or the mileage that's driven throughout the year is really high compared to your income. So for example, I had someone who told me that their mileage for the year deduction was almost $80,000. Whoa. So that would have meant that she was driving well over 100,000 miles in a year just for business purposes, which is unrealistic. So from that perspective, I informed her that she's probably going to get audited or, waived down. So that's something that you definitely want to consider. I will say too, making sure that you use a separate account for your transactions that are separate from your personal, because I've seen this happen a lot of times where people forget that they may have gone to Target to purchase something for their business at the end of the year just because they're looking at all their transactions, and they typically go to Target for, maybe groceries, and maybe they went to Target and bought a printer this particular time. And so when you have those accounts commingled, a lot of times it's difficult to dig out your business expenses or find them, just because, especially a year later, you've probably forgotten what you did a year and those purchases that you made. And then some other things that I think self-employed individuals need to be cautious of is retirement. When we're working for someone, that retirement account is automatically set up for us in a lot of cases. As self-employed individuals, we also have to remember that one day we're going to retire. So it's important that we're setting up those SEPs or those IRAs or for our own selves, and maybe even our employees, but definitely ourselves, so that we are saving for retirement and we have those funds available to us at that time.
All right, and that's a good point, retirement. It's sometimes hard to do, right? When you're self-employed, you pay your expenses and then you pay yourself salary, and maybe there isn't always money left over. Is there a good tip or trick for self-employed individuals to put that money aside, or what to do with that money for retirement purposes?
So even with solo 401ks, you can start off as little as $25 per month putting money aside. And so you can start off that small, and as your organization grows and you have more money coming in later on, then you can start growing the amount that you're putting in on a monthly basis. But I would say start small, and then just grow it over time.
Okay,
That would be
great.
my
$25 a month seems doable for most of us. And then we can just throw in extra money as we go.
Mm-hmm. Yes.
Rolanda, this was such great information. Any parting tips or tricks or words of wisdom you want to give those self-employed people out there?
I would just say be cautious of trying to write off all your, I'll say this, be cautious of trying to write off expenses that don't exist. I've seen business owners get themselves in trouble where they're trying to lower their tax liability in ways that are not necessarily legal, but it also comes back and bites them in the foot, especially when they're ready to purchase a home or purchase a vehicle, and you're showing that your business is not making any money. Well, when you go to the loan officer, the first thing that they're going to ask for is the last 2 to 3 years of your tax return. And if you're not showing income, it's going to be very difficult to get a loan at that point in time. And so just being cautious of that. Again, I'm not saying don't write off legitimate business expenses, but yeah.
Yes, that's a good point, right? I guess, trying to lower your income for purposes of taxes is one thing, but when you need to show that you've made some income when it comes to loans and purchases and things like that credit, it's important to have that balance. So that's a good point for everybody out there to remember. Rolanda, thank you so much for your time today. I so appreciate it. You did a great job and gave us some good information and some thoughts. Everyone out there who joined us today, I hope you got some great takeaways. I hope you all enjoy the rest of the week, and we'll see you next time.
Thank you. Thank you for the invite.